Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
Welcome to This Explainer. Let's get right into it, because today we are breaking down the crucial new 2026 charitable contribution rules and record-keeping requirements. As tax professionals, staying ahead of IRS changes is literally the foundation of what we do. And, well, we all know exactly why 2026 is looming so large on the horizon right now. With so many provisions of the Tax Cuts and Jobs Act set to expire, the entire tax landscape is bracing for a massive shift. So today, we're going to prepare your firm and your clients for a very specific upcoming change in how charitable deductions are handled. We want to make absolutely sure that when the new rules take effect, your compliance blueprint is already firmly in place.
So, here is our roadmap for today. We'll be hitting 5 essential sections: the 2026 non-itemizer deduction, verifying qualified organizations, the cash donation record-keeping rules, the $250 acknowledgment threshold, and finally, non-cash contributions and forms. All right, let's kick things off with Section 1, the 2026 non-itemizer deduction, and how we can prepare for this upcoming tax year shift. You already know the drill here. Historically, the general deduction rule dictates that taxpayers have to itemize on Schedule A of Form 1040 to claim any kind of charitable contribution. But when the TCJA was passed, it drastically reduced the number of taxpayers who actually itemized. It essentially wiped out the direct federal tax incentive for charitable giving for a massive swath of middle-class families. If your client took the standard deduction, their charitable giving just didn't move the needle on their tax liability. But guess what? We're looking at a specific carve-out on the horizon. The IRS is bringing back a sort of micro-deduction incentive, and it's a fantastic opportunity for proactive client advisory. Beginning with tax year 2026, a new rule takes effect specifically for those who do not itemize. These non-itemizers will now be able to deduct cash contributions made to qualified organizations.
So what's the actual number? Under this new 2026 rule, individual taxpayers who don't itemize can deduct up to $1,000 in cash contributions, but that limit doubles to a maximum of $2,000 for married taxpayers filing jointly. Think about a practical everyday scenario. Imagine a married couple filing jointly who take the standard deduction and they casually drop cash in the church collection plate or have a recurring monthly donation to a local food bank. Previously, that routine generosity yielded absolutely zero federal tax benefit. But in 2026, capturing that $2,000 limit translates to real, tangible tax savings. It's absolutely crucial to emphasize to your clients that this upcoming deduction is strictly for cash contributions made to qualified organizations. This is a brilliant tax planning opportunity for middle-income clients, but it means they have to start preparing their tracking methods right now to actually take advantage of it.
Moving right along to Section 2, verifying qualified charitable organizations. Because let's face it, a client's good intentions do not automatically equal IRS compliance. We see this issue all the time, right? And it creates incredibly awkward conversations. A client comes in with a receipt for a heartfelt donation, fully expecting a write-off, but it doesn't actually qualify under the IRS rules. You have to actively advise your clients that donations made directly to individuals are strictly non-deductible. This is the infamous GoFundMe loophole. Clients will try to argue that a generous contribution to a neighbor's medical fund or a community member's tragedy should be deductible, but you have to explain that no matter how worthy the cause, if the money goes to an individual's personal fund and not a registered 501c3, it simply cannot be claimed. To protect your firm from audit risks, instruct your clients, and honestly your own staff, to always verify an organization's status. The absolute single source of truth for this is the official tax-exempt organization search tool right there on irs.gov.
Okay, Section 3, cash donation record-keeping rules. This is literally the foundation of compliance. Good records make filing easier, and they are your only defense if a deduction gets questioned. To support a deduction on a federal return, keeping highly organized records of all monetary gifts is not a suggestion. It's mandatory. For every single cash or check donation, taxpayers have to keep either a bank record or written communication from the charity. And that documentation must explicitly display 3 non-negotiable pieces of data: the organization's name, the exact date of the contribution, and the exact amount donated. We've all experienced that dreaded busy season moment, haven't we? A client hands over a shoebox of crumpled, faded receipts or a credit card statement that just vaguely says PayPal *charity and expects you to make tax magic happen. A statement without a specific date or proper organization name just isn't going to cut it under audit scrutiny. Setting this rigorous standard with your clients now is going to save you countless headaches and workflow friction down the road. Which brings us to Section 4, the $250 acknowledgment threshold. This is all about handling those larger monetary gifts. Once a single contribution hits $250 or more, whether that's cash or property, the standard bank record is no longer enough. The rules escalate. A written acknowledgment directly from the qualified organization is strictly required before the deduction can even be claimed. This letter has to outline the exact cash amount or provide a detailed description of the property donated. But more importantly, this threshold introduces the classic quid pro quo trap that catches so many taxpayers off guard. The documentation must explicitly state whether the organization provided any goods or services in exchange for the gift. If they did, the acknowledgement has to include a good faith estimate of the value of those goods or services. Say a client buys a $500 ticket to a glamorous charity gala, but they get a dinner valued at $150 while they're there. You need to make it crystal clear to them that only the $350 difference is actually deductible, and the charity's letter must state this estimate. Finally, let's tackle Section 5, non-cash contributions and forms. Time to navigate some escalating complexity. Non-cash donations require a much higher level of diligence, and frankly, they're a huge source of friction between preparers and clients. Taxpayers have to keep detailed records describing the donated property, and they are entirely responsible for recording its fair market value. Form 8283 can be notoriously annoying to deal with. Clients love to overvalue those bags of old clothing they dropped off at Goodwill, but at the end of the day, CPAs are the ones signing the return. That makes robust client education critical here. For non-cash contributions exceeding $500, you'll need to prepare and file Form 8283. And when we hit larger non-cash donations, specifically property valued at over $5,000, you have to ensure the client secures a qualified appraisal. This is absolutely not something that can be easily fixed after the fact, so proactive communication is essential.
Before we wrap up the technical side, always remember the IRS has specific guidance for unique assets. Special rules apply to things like business inventory and other readily valued property. But the biggest headache? Automobile donations. Clients always assume they can just deduct the pristine Kelley Blue Book value of the old sedan they donated. In reality, their deduction is frequently limited to the gross proceeds from the charity's actual sale of the vehicle, which is reported to them on Form 1098-C. When you run into these situations, rely on the official IRS documentation. Refer to Publication 526 for general rules, and use Publication 561 as your go-to for determining the value of non-cash contributions. Keeping those bookmarked will definitely streamline your workflow.
We have covered a lot of vital ground today, from the new $1,000 and $2,000 cash deduction limits for non-itemizers coming in 2026 to the strict documentation and appraisal standards required to survive IRS scrutiny. Organized records protect your firm's clients and dramatically streamline the tax filing process. So, as we wrap up this explainer, I want to leave you with a real challenge. When tax year 2026 arrives, will your firm be scrambling to retroactively fix your clients' undocumented donations, or will you be the trusted advisor who put the blueprint in place 2 years early? The choice depends entirely on the conversations you start having with your clients today. Thank you so much for joining me, and I hope this helps you and your firm stay well ahead of the curve.